Trump's proposed tariffs on Vietnam could have sweeping consequences for U.S. businesses, especially those that have increasingly turned to Vietnam as a strategic manufacturing partner. Over the past few years, as the U.S.-China trade war escalated, Vietnam emerged as a key player in the China Plus One strategy, a move by global companies to diversify their supply chains and reduce dependency on China. However, with the U.S. now considering or imposing tariffs on Vietnamese goods, this approach may be severely disrupted. U.S. companies that relocated production to Vietnam to avoid high Chinese tariffs may now find themselves back at square one, facing rising import costs and a renewed search for affordable, reliable manufacturing alternatives. Industries that rely heavily on Vietnamese manufacturing are expected to be hit hardest. This includes sectors like apparel, electronics, furniture, footwear, and basic consumer goods. Brands such as Nike, Adidas, and Lululemon manufacture large volumes of their products in Vietnam due to the country's cost advantages, strong labor base, and stable production infrastructure. With tariffs, the cost savings that drew them to Vietnam could quickly evaporate. For tech companies like Apple, HP, and Intel that have also been shifting parts of their production to Vietnam, these changes could result in supply chain delays, reduced margins, and disrupted product timelines. Small and mid-sized U.S. businesses may be even more vulnerable. These companies often lack the financial resources to absorb increased duties or rapidly restructure operations. For many startups and direct-to-consumer DTC brands, Vietnam is not just an option, it's the foundation of their pricing and profit models. If tariffs significantly raise the cost of goods, these businesses will be faced with tough choices. Absorb the cost and reduce margins, pass it on to consumers and risk losing market share, or attempt to relocate again. An expensive and time-consuming process. From a broader macroeconomic perspective, the move signals growing global instability in trade relationships. It raises concerns about inflation, consumer price hikes, and increased operational risks for global companies. Investors may also react negatively to these developments, particularly if they affect the profitability of publicly listed companies with high exposure to Southeast Asia. Market sentiment, already cautious amid global economic uncertainty, could shift further toward risk aversion. This potential shift also forces companies to reassess future manufacturing strategies. With both China and Vietnam under tariff pressure, the next logical production hubs could be countries like India, Bangladesh, Indonesia, or even Mexico for U.S. nearshoring. But transitioning supply chains takes time and capital. For many businesses, it may also mean dealing with new regulatory environments, infrastructure limitations, and labor challenges. In the long run, while some local U.S. industries may benefit from reshoring and domestic manufacturing incentives, the short to medium-term impact of tariffs on Vietnam will likely be negative, raising costs, shrinking margins, and increasing uncertainty for countless U.S. companies and consumers. It's a stark reminder of how interconnected global trade has become, and how quickly government policy can reshape business dynamics. If you found this breakdown helpful, don't forget to like, comment, and most importantly, subscribe to Scoob Wealth Grid. We bring you clear, in-depth insights into global economics, business strategy, investing, and financial trends to help you stay ahead in a changing world.